Hello and welcome to the Global View on this Thursday. Well, UK inflation has fallen to its lowest rate in more than 2 years. Annual consumer price inflation falling to 3.9% in November from 4.6% the previous month and well below economists' forecasts. The data saw the 2-year gilt yields tumble more than 19 basis points to 4.08%, while markets have now priced in 53 basis points of rate cuts for the first half of next year, or 137 basis points of cuts by next December. This comes as US central bank officials push back against market expectations of imminent rate cuts. Investors now awaiting US inflation data on Friday for clues to future Fed policy action. Meanwhile, US consumer confidence increased more than expected in December amid optimism about the labour market, and existing home sales increased 0.8% last month. And that surprising UK inflation data pulled government bond yields lower globally, with the US 10-year yield falling to a 5-month low of 3.87% before rising slightly, the 2-year falling to 4.38%. And the British pound weakened against the US dollar following that consumer price data. The Aussie dollar trading at 67.3 US cents. Well, for more on the outlook in the States, particularly in terms of how equities are responding to what we're seeing at a macro level, Sam Stovall, Chief Investment Strategist from CFRA, joining us now. Sam, very good to catch up with you. Thanks for joining us. So, of course, we have seen that equity rally run hard, the so-called Santa rally, into the end of the year. Interesting to see what we just saw in that last session. Some profit taking, clearly. What were your observations?
Well, I was trying to figure out, Andrew, what actually triggered that sell-off at about 2 p.m. And I really think it just ended up being more of a technical trade, because nothing really has changed from a fundamental perspective. But when you look at the number of stocks trading above their 50-day moving average, the number of sub-industries in the S&P 1500 at 95%, and typically we start looking overbought at 85%, I think investors basically said, we went too far and it's time to digest some of these gains, and that's what they did.
Sam, what are you seeing at an index level at the moment? Clearly that Fed meeting last week with Jay Powell's comments put more of a rocket under the market, and of course since then we have seen that pushback from various Fed members. Do you see that as an inflection point, obviously, as we talk about rate cuts next year?
Well, I think it's interesting. It sort of reminded me of squabbling siblings who can't really agree on anything. And so you have one Fed member say, the Fed has tightened enough, let's wait and see. Another Fed member then comes out and says, no, we haven't. So I think what they're basically telling us is that the Fed remains data dependent and they will respond to whatever the inflationary trends happen to be. But right now, they're on target to start lowering rates in the second quarter of 2024, in our opinion, and will lower by 25 basis points in each subsequent quarter. So 3 cuts next year rather than the 4 or more that the street is looking for. And I think should we get that slower and lesser kind of cut environment than investors are currently expecting, that probably could add to volatility and maybe even lower the overall angle of ascent for the market, at least early in the new year.
So let's take a look at the S&P 500, Sam. What are you seeing there? Is that momentum likely to push into the new year, do you think?
Yes, I do. If you're a Star Trek fan, you can make the analogy that the year end is acting like a tractor beam, where we're looking at the new all-time high for the S&P 500, now about 2% away from where we closed this evening, but still very much within reach. History then says once we have recovered everything we lost in the prior bear market, which is what we will do, there's a much greater likelihood of our advancing by another 5% than falling immediately by 5% or more. So I still think that there is some upside potential. We will likely get that Santa Claus rally, which really is the last 3 trading days of the calendar year, first 2 trading days of the new year. And then let's also see what the January barometer holds. As the old saying goes, as goes January, so goes the year.
Sam, let's cast ahead to the prospects for next year. Once the Fed does actually start cutting, what's the likely response from equity markets, do you think?
Well, it's not as strong as the period before the rate cuts. So, in the average 11-month period between the last rate hike and the first rate cut, since the Fed started telegraphing Fed funds moves in the late 1980s, the S&P was up 14% and rose in 5 of 6 times. After the Fed started to cut rates, 6 months later, the market was still higher by about 6.5%, but was up 4 of 6 times. So you could end up, depending on why the Fed is cutting rates, if it's because they're worried about a recession, or in our opinion, it's probably because real rates are too restrictive and the Fed wants to go back more toward a bit of equilibrium. If we do end up getting that soft landing, then I think this will still end up being a positive return even after the Fed starts to cut rates.
So is it likely that investors are likely to seek those quality equities?
Well, I think quality is certainly the area where investors might be focusing. History also tells us that following an up year, you want to let your winners ride by continuing to hold the top 3 performing sectors from the prior up year. In that next year, those 3 on average outperform the market 70% of the time. And if you look at the 10 best performing sub industries from that prior year into the new year, they have outperformed about 73% of the time. So if you want to look to next 2024, stick with tech, consumer discretionary, communication services, and maybe add financials and industrials to the equation. But I would not expect a lot of octane to come out of staples, healthcare, or utilities.
So, of course, we shouldn't forget that next year is an election year. What does history tell you about equity market performance in such years?
Regardless of whether the incumbent is reelected or replaced, first-term president election years have posted positive total returns, averaging 15.5%, and never declined. Of course, we're looking at a limited observation of 14, so there's no guarantee that history will repeat itself, but it's certainly an encouraging statistic.
Taking a look at the smaller end of the market, those small caps have obviously struggled over the past couple of years, although we have seen a turning point, particularly in December. I think the Russell's up around 11% or so. What's your view?
Oh, I think small caps are going to continue to outperform into the new year. Just a short while ago, both the S&P Mid-Cap 400, Small Cap 600 were trading at a more than 35% discount to their average relative PE ratio over the last 20 years, and had underperformed large cap stocks in 8 of the last 10 years. So I think with stronger than expected or stronger than the 500 growth rates for mid and small cap stocks, plus now the opportunity to make up for lost time, especially since the Fed is likely to be cutting interest rates and thereby relieving pressure on many of these debt-dependent small cap stocks, I think they definitely have good upside potential yet.
Sam, what does an appropriately balanced portfolio look like in 2024, do you think? Obviously, there has been talk about whether the 60-40 strategy is dead or not. But when you take a look at that allocation to equities and fixed income, what's your view?
I definitely do not think that the 60-40 allocation is dead. I mean, it looked dead last year, but I think it is revived because the fact that whenever we've had a very strong down year for fixed income, we've ended up rebounding quite nicely as we did in 2023, and also following down years in the S&P 500, you've actually seen a 10 percentage point improvement in the frequency of advance in that subsequent year. So we recently, when I say recently, the beginning of fourth quarter of this year, increased our bond exposure Also, we are emphasizing mid and small cap equities. And our belief is that we're likely to see an improvement in international shares because the developed international index is trading at a 20% discount to its historic relative PE. And you'll be probably happy to know that the Australian market is trading at about an 8% discount to its long-term average. So should we see a reversion to the mean as well, we could certainly see developed emerging markets, and in particular, Australian markets do well.
All right, that's a great pointer right there. Sam, should you be rotating out of cash at this point?
Well, I think that depends on where you want to be going. But yes, I think a 5% yield is pretty nice and will stay at that 5% level so long as the Fed has not started to cut interest rates. But certainly there are better opportunities in equities and in some fixed income areas. So I would tend to say that higher yielding stocks that have high quality look fairly attractive at this point, and many of them I think you can find in the S&P 500 financials and industrial space.
Sam, great to get a view of your strategy there at CFRA. Happy holidays. Thanks for joining us.
My pleasure.
Sam Stovall, Chief Investment Strategist at CFRA. All right, now just a check at the market. Look, we are expecting a lower open. As you can see, SPY futures now down close to 1%. That's after that sharp reversal we saw on Wall Street late in the session just gone. Quick programming note for you. Be sure to join us this afternoon. We're going to be catching up with Dan Draper, Chief Executive of S&P Dow Jones Indices. He's visiting Sydney and will be here in our studios talking everything from key trends to the next generation of indices beyond core equity benchmarks. That is from 3:40 Eastern here at AusBiz. Stay with us. The Open is next.